Everyone, welcome back to another episode of Capitalize on Retirement. Today we are talking about markets, diversification, and we kind of want to talk about the risks no one's talking about in 2026. And I think the biggest thing is you and I have been talking about this, and a lot of the families we serve, we've been talking about it. Markets have been really strong for the past couple of years, and and even during that time, headlines are loud. There's opinions everywhere. So we want to talk about perspective of the market, not necessarily like these aren't predictions. We don't know what the market's going to do. We're not talking about that, but let's give some perspective into what we're seeing into this market.
Yeah, so you don't see this often, but for the past 3 years, the market has had 15+% returns.
Yep.
And when we say that, we're typically talking about the S&P 500. And so the S&P has realized, just looking at it, in 2023, we've seen a 26.3% return. In 2024, the S&P was at 25%. And then in 2025, the S&P was at 17.9%. And so that's very rare to see three positive market returns in a row where it's 15+%. And so we start looking at that and saying, well, where can we go from here?
Yeah, I mean, that's only happened a handful of times throughout history.
Yeah.
In the stock market's existence. So you mentioned it, extremely rare. And, now we're in the 2026, and that's what we want to talk about. And just because that the market's been so good, that doesn't mean the market's going to crash.
Right.
Not
Exactly.
at all. That's not what we're saying. But expectation should be realistic.
Yeah, I mean, I think right now, and we say this all the time, it's about fear and greed in the market.
Yep.
And when, the markets are going and they're doing really well and people are making money with their investments, they want to be as aggressive as possible.
Yep.
But that's usually the time where you want to look at things and say, okay, how do I protect myself moving forward?
Yep.
How do I diversify? How do I rebalance where I'm at? And so I think now is the perfect opportunity for that, not saying that markets are going to go down, right? We're not predicting that. We're just saying maybe now is the time to let's rebalance, let's get diversified, let's get back on track.
Yeah, and I mean, I'm looking at this chart over here that shows the 8 times throughout history the market's gone up more than 15% 3 years in a row. And 4 of those times, the market came back positive the next year. 3 of those times, it was negative, and obviously this is the 8th time it happened, so we don't know what's coming for 2026. But I think, looking at that, returns do tend to moderate at some point in time, right? We're not going to see these massive spikes. It is a little bit unusual for a stock market, but we're on the verge of AI, so again, we don't know what's going to happen there. I think one thing that I anticipate is volatility increasing.
Yeah. Definitely.
Right. We've seen volatility, but I see an uptick in volatility here coming soon.
Yeah, I think it's natural too. I mean, as markets continue to rise like they have, I mean, volatility should rise, especially with inflation and interest rates. I mean, interest rates, they're talking about lowering interest rates. Mm-hmm. Well, that's sometimes good for the market.
Yeah.
But it's hard when what's inflation going to do,
yep.
right? And so if inflation goes up, the Fed might be forced to lower interest rates. So I see, like you said, a lot of volatility coming because it's a tough thing to navigate for the Fed.
No, it is. And I think what will lead us into our next portion of this, because we anticipate a lot of volatility, we think diversification matters more now than ever. And when I say that, we'll go into this, but I think diversification is going to be more important now than ever, because if you were in the stock market over the last couple of years, you've made a lot of money on your stocks. And most people aren't necessarily rebalancing, taking some chips off the table. So that means you're probably overweight in certain areas. So that volatility hits you a lot harder than it did 3 years ago.
Yeah.
Right? And you have more money in your accounts now too, so you feel it a little bit more. So I think the biggest thing is, we don't know what the market's going to do. We have no idea. There's a lot of good things on the horizon. There's a lot of news out there and the talking heads. But I think diversification is going to be critical over these next couple of years as we enter in and, we keep going into that.
Yeah, and, there's a piece that we really like because it talks about, asset classes and diversification. And, just looking at some of these stats, like, looking at 2019 and 2020, large cap growth, they were the top performing assets, right? And so short-term bonds in 2019 only made 4% versus large cap growth was positive like 36%. And it depends on which indexes you're looking at.
Yeah.
But let's fast forward to 2022, large cap growth was the worst performing asset.
Yep.
Right? And so there's a lot of different things going on there. I know 2024 foreign stocks were one of the worst performing assets, but in 2025 they were one of the best performing assets. So we say this all the time. We don't know which asset class is going to perform well in a given year. We just know that if we own all of them, eventually they should all, if you own the right stuff, they should all do pretty well over a long period of time. Yeah, so you want to be diversified.
You want to be diversified. You want to hit that blended rate of return. Like commodities are a hot one this year, right? And looking at this chart, commodities were and that's kind of our gold and silver and things like that. Yeah. Those were near the bottom of this chart almost every year.
Yeah.
Right? They had a couple years like 2007, they were the best. A couple years in the middle, but last year they were a great performing asset class, right? Everybody knows about gold and silver, and now everybody wants to rush to gold and silver. We believe in owning gold and silver, and we've had it in our portfolio for a number of years, but that's because our goal is to diversify. I mean, I tell people this all the time. If we went into the year knowing, like last year, the best performing asset class was foreign stocks, which we owned in our portfolios. If we knew that was going to be the best performing asset, we would just own that.
Yeah, right.
But we didn't know that, so that's why, again, we're taking diversified approach to everything.
One of the things that I've noticed is, a lot of the families that maybe came into one of our seminars, or they were referred to us by one of the families that we serve. They come in and a lot of their portfolio just consists of U.S. large cap stocks. Well, that's great, but last year foreign stocks were the best performer. So that's why it's so important to be diversified and not just get on what is the trend right now, because you never know when it's going to flip.
Yep, and a lot of people, like I know a lot of people who do it themselves, they'll come in and they'll tell me the way they pick their 401k funds when they came in. And I just look at the 10-year returns or whoever did best last year. And that's not necessarily the way you want to pick your allocation, because just because they did the best last year definitely doesn't mean they're going to do the best this year.
Yeah, I mean, commodities last year were up 15.77%.
Yeah.
And so when I look at that, I look at the 20-year return of commodities, and it was a negative return.
Negative return.
So it averaged a negative return over 20 years. So, we're not saying that that's something that you'd be happy owning for 20 years. But last year it was up 15%.
Yeah.
So we're not saying that you need to pick one or the other. We think you should have a blend of all of them and just really make sure you're diversified, especially during these times.
Yeah, and that's the thing. A diversified portfolio, looking at this, averaged 7.25%. In the last 20 years, large cap growth was 13%. We don't know what the next 20 years are going to look like, but throughout history, that diversified portfolio has been sitting in that range.
Yeah. Yeah, the gains aren't as that you're not going to make as like if you blend in these bonds and different things. There's a lot of bond positions in here. The blended portfolio that we're talking about, the highs aren't as high, but the lows certainly aren't as low.
No.
And so, depending on where you're at, if you're a younger investor, sometimes you can take more risk. If you're getting ready to retire or you're there, sometimes taking less risk is what makes the most sense.
No, I agree. And I think leading into that too, is we're talking about diversification. We kind of explained how those asset classes work and why you can't just try to pick one because you don't know which one it's going to be. That's not necessarily the right approach. But many portfolios, because there's so many different options, if you will, we talked about direct indexing last week, mutual funds, ETFs, and there's millions of different mutual funds and ETFs. So you can own multiple mutual funds, and it looks and feels like you're diversified.
Yeah.
But when you look under the hood of most of them, they're all going to own some large U.S. tech names, like your Google, your Apple, your Facebook, your Microsoft, your NVIDIA. So just because you own Growth Fund of America and another U.S. growth fund over here, they might be operating almost identical, but to you or the consumer, it feels like you're diversified, when in reality you're not. And that's why that volatility that we talked about, that's why I think people are going to have major impacts in that area.
Yeah, we see that all the time. Somebody has a portfolio and they see that they have 7 different mutual funds. What do they own? Right? You want to get under the hood and see what they own. And so, like you said, sometimes people own Apple in 7 of their mutual funds, which maybe that doesn't make sense, right? Maybe I don't need to own Apple 7 different times.
No, I don't think that was their goal either.
Right. They just don't understand what they're actually investing in.
Yeah, and that again, that's kind of why we like direct indexing. But refer to the last one. I mean, I think the key message there is owning more funds doesn't mean you are diversified.
Right.
Diversification is different ideas, different asset classes, different themes in a portfolio that fits your goals and your needs.
Yeah. Yeah, and I don't want to get too much into the weeds here, but I think an asset class like international ownership makes a lot of sense at this point.
Yeah.
And we're not predicting that that's going to be an outperformer. We're just saying, hey, we've been very overweight in U.S. stocks. Well, there's been periods of time where international has really led the way for long periods of time.
Yep.
And so I think it's, like we said, just very important. Look at the portfolio that you have now and let's see, how should I be invested at this point? Should I start balancing things out?
I know, even just speaking on that, because a lot of people know international has lagged the U.S. for the last 20 years. And they absolutely have. So whenever we're going through like our proposal meetings and we're showing people the allocation and they see international, oh, well, I don't think I want international. But again, it's about having a diversified portfolio. Yeah. And to be diversified, we have to have international. But I think that is going to be more important over the next 20 years just because market leadership, it rotates over time.
Yeah.
And, we're going to have these longer periods where, international emerging markets – they could lead in performance. We don't know that.
Yeah.
But they could. I mean, the U.S. has been leading the way for the last 20 years, and we believe in the U.S. economy. Absolutely.
Definitely.
But the market does tend to change over time.
Yeah.
So, again, we're not telling you to go all in the international stocks, but we're telling you should own a piece of it.
Balanced portfolio. Definitely.
Balanced portfolio.
So, I guess let's talk about what we think is the biggest risk for 2026. And, I think the biggest risk for 2026 is going to be inflation. I really do. I mean, the rise of the cost of goods. We talk about that all the time. We obviously seen that happen, during the pandemic. I mean, the cost of everything went way up. And so I think that's going to be our biggest risk and tied into interest rates and what that's going to do, what the Fed's going to have to do with that. So
inflation's one of those things that we call it a silent assassin, right? It's like a silent killer because it erodes your purchasing power over time. I mean, think about it. In 1980, a gallon of milk cost a whole lot less than it does today.
Yeah.
Right? So if you were in cash that whole time, you're not competing with inflation. So inflation is just slowly eroding purchasing power. It's corporate earnings, right?
Yeah. Somebody actually, and I actually have this written down. I look at it all the time. When I was first getting into this industry, I read a finance book, and the quote that was on there, I actually have it written down. It says, inflation tells us how expensive everyday life is getting.
Yeah.
So when prices rise too fast, the Federal Reserve has to raise interest rates to slow spending and borrowing. So basically, a lot of people ask us all the time, well, how does this all work together? How's inflation and interest rates? Well, the Fed has to raise rates, which slows spending. And so higher rates make loans, mortgages, all of these things more expensive. If you think about it, like everybody wanted to buy a home during the pandemic because rates were very low.
Yep.
But now it's much harder to buy a house.
Yep.
And so that's slowing things down. That's when inflation was 9%, the Fed raised rates. They wanted things to slow down a little bit so it didn't get out of control. And so that happened. And so, now that inflation comes down, interest rates can eventually come down again. They're trying to lower them, which typically stimulates the economy, but you never really know where it's going to go. So that's kind of the goal.
That is, and I think that's the other thing, because you just said it, right? If people aren't spending as much money, the economy isn't growing as fast.
Right.
So that is why lower rates, lower interest rates, lower inflation really help stimulate our economy because people have more discretionary income to go out and spend in their everyday lives doing things.
Yeah.
Whereas, excuse me, if you don't have that, then you're not spending that money, which isn't in turn stimulating that economy, creating jobs, creating revenue for these Fortune 500 companies.
Yeah, definitely. Yeah, and I mean, when I think about that, when we talk about inflation, I think it's one of the biggest risks. And a lot of people say, well, I'll just wait until they lower rates and then I'll put my money in the market. Well, the biggest problem with that is typically the markets move before those rates move and all these things happen. So trying to time it is almost impossible. And that's why, like we said, having that balanced approach, that really usually wins over time.
Yeah, it's just it's the way to go because nobody has a crystal ball and they don't know what's going to happen right, and we'll make it work. Whereas if you're just throwing darts on a board, you're just throwing darts on a board, right? We don't know what's going to happen. I mean, in 2008, a diversified portfolio was down 29%. That's not great. Large cap growth was down 38%, right?
Yeah.
So, I mean, again, that's a big difference.
Yeah, and mid cap was down 44%, which is crazy. So, yeah, I mean, there's big swings in these things, and, who wants to see their portfolio go from – lose 44% one year and then make 58% the next year. I mean, nobody wants to see those big swings in there with their money. And so,
and the families that we serve, they don't need to see those big swings, right? Most of them have already won the game, and we don't need that anymore. Right. It's not that we don't want it, but we don't need it. Right. So why risk what you have for something you don't need?
Yeah, we want the greatest return for the least amount of risk.
That's
right.
It's about as simple as it is, but that's a fact.
Yeah. So let's talk about what this means for investors and kind of wrap it up. I think this isn't a panic environment. Like a lot of economists, I listened to this one economist and he was basically saying how 3 market returns in a row that were really positive, he's predicting like a 25% loss in the market, and it's one of those things where I don't think we have to take it that far, right? Because it very well could go up again. We know how these predictions go, right? They're wrong a lot. And so I think it's a planning environment. It's not a panic environment. It's a planning environment.
Yeah. No, I couldn't agree more. I mean, if you watch CNBC, I mean, I watch it every morning. I know you do too. And it's on here in the office. You'll have, if there's 10 people on throughout the day, 5 of them are saying the market's going to crash and 5 of them are saying it's going to be a great year. I mean, personally, I think the market is going to have a great year, but I don't know that.
Right.
There's fundamental indicators that are saying that, but then we have inflation and interest rates that we got to worry about. I think the biggest thing is planning, right? We've made a lot of money over the last 3 years. Yeah. What are we going to do with that? Those are paper gains.
Yeah.
And when the market goes down, there's paper losses, but we can solidify some of those gains by moving things around, moving things to annuities to protect them, moving things to bonds to make them a little more secure, right? Not as safe as annuities, but it's an environment that we need to be prepared for. We need to be proactive and not reactive because, fear and greed, right?
Yeah.
Market's been great. We're greedy. As soon as we catch that loss, then we're a little bit fearful and we don't want to do anything. Right. Now's the time to be proactive.
Yeah. And I just want the viewers to understand this because we've seen this a lot where there's a lot of market downturns throughout the year. And so people start to say, well, this is it. This is another 2008. And all of a sudden the market recovers and we're in fine shape, right? Yep. So I see that a lot, and it's important for people to just not panic during those times.
When it's happening, like April of this year, when it's happening, everybody reacts. It's very emotional.
Yeah, April of last year, 25.
Last year, yeah. April of last year. When it happens, it's very emotional. It really is, and that's, again, people tend to make poor decisions when that happens. That's why it's, hey, let's be proactive. Let's plan for this because it's important.
Yeah, and I think, just closing out, I think markets will keep changing. Headlines will keep rotating. The goal is discipline, diversification, intentional planning, right? What makes sense for mine and your situation, not everybody else's, right? Let's focus on what do we need for our situation because everybody is different.
That's where the planning comes in. I mean, confidence comes from clarity, not predictions. So I think, let's make sure we have a plan. Let's make sure we're confident going into 2026. And as we get through 2026, I know we're excited for this year, and we're excited to continue to help the families that we serve and have some fun.